Hello and welcome to our weekly Understanding Markets webinar. We are recording this on the afternoon of Tuesday, the 15th of March. I'm Hellen Dalton, a Senior Investment Manager with Cantor Fitzgerald, and I'm joined again by our Chief Investment Officer, David Beaton. We're also joined by our Head of Fixed Income Sales, Ryan McGrath, who sheds some light on the thoughts of central banks around the world. But first, David, it's been another tumultuous week in markets.
It has, Helen. This time last week, we were assessing the impact of the Russian invasion of Ukraine. Oil prices had hit multi-year highs, up to $139. Equity markets were trading near their lows, particularly in Europe. The DAX at its worst was down over 23% year to date this time last week, and even US markets, while they were relatively outperforming, had done better, but we're still under a bit of pressure. And we saw the usual flight to safety into bonds, gold, silver, and other commodities, and the US dollar. Over the course of the last week, now we still have this air of volatility surrounding markets, but it's interesting to see how well, it's hard to say positive news flow out of Ukraine is at the moment. It's clearly the situation has intensified. But where the market is taking some optimism from is that they're now, Russia and Ukraine are now in their fourth round of talks. And the news coming out today is that some progress appears to have been made. Whether it ends up with a Russian withdrawal, whether it ends up with just a ceasefire, but the market is taking any incremental positive headlines like that in its stride. And we've seen the DAX rally 7.5% from its lows last week. European markets generally recovering. I think the other important thing that's helped equity markets stabilize to a certain extent is the sanctions that have been imposed by the West haven't included oil and gas out of Russia. Yes, the US did ban the use of Russian energy, but Europe and the European Union have not done that. So that's seen oil prices come back significantly, which has certainly helped the inflationary outlook in the short term. And Ryan might touch on that when he's commented about the central banks. But overall, I won't say we're out of the woods yet in relation to the volatility, but certainly the headlines that we've seen thus far since last week have been a little bit more market friendly than we might have expected.
Thanks so much, David. And Ryan, the ECB met last week. They were expected to be incredibly dovish, but surprised with a more hawkish tone.
Yes, Helen, it was a big surprise by the ECB last week. I mean, you got to remember this was an institution that's been very, very cautious the whole way through the pandemic. Now, if you go back to the previous meeting before this one, Madame Lagarde, she did open the door for some sort of hawkish pivot. The consensus was then built following the conflict in Russia and the Ukraine that the ECB had every reason to go on to pause and not to actually quite go through with the hawkish pivot. But not only did she do that, she went far beyond what the market was expecting regarding the pace of reduction of asset purchases. She brought that forward arguably to the end of June from the end of October. I think the big question that everyone in the market was left with, what are the ECB seeing now that they weren't seeing a month ago? I think if you answer that, it looks like the additional inflation that's going to be caused by the conflict in Russia and the Ukraine, on top of what the ECB referred to as the pandemic cycle of inflation, was just too much for the ECB to stomach, and they reacted to that. My fear on this now is that the ECB are behind the curve. They've made adjustments to try speed up. They're in their new projections, they're looking at inflation of 5.3% in 2022. That is a big number by their standards. And I think the ECB, they're behind the curve now, but they are of the feeling that the curve will come back to them in 23 and 24. They have inflation forecast at 2.1% in 2023 and 1.8% in 24. So I think the risk for them is that not only are they behind the curve now, that they will actually go further behind the curve if there's scenarios don't play out. The interesting thing is now, as you said, we're into another huge week for central banks. We have the Federal Reserve now. So there's no reason to think that the Fed, who are actually quite hawkish themselves, are going to be any different to the ECB. And what are the Fed seeing now on top of what they were seeing earlier in the year? I think it is this supply side shock that that is going to stimulate further inflation into the economies, is really going to spook markets. So I think 25 bips is absolutely done by the Fed. They are, they are going to do that tomorrow. It's going to be the first rate hike since 2018. The market has now moved to price in around 6 hikes this year by the Fed, which could be on the more aggressive side, but bear in mind at one stage the market was looking for a 50 bip hike at this meeting from the Fed. That has come back to 25, but I don't think that Mr. Powell will leave the 50 bips off the table for future meetings.
Thanks, Ryan. It's a very fine needle that Mr. Powell has to thread there, that's for sure. We're also hearing from the UK Central Bank and Japan as well this week.
Yeah, absolutely. The UK Central Bank, or the Bank of England, I mean, they've arguably been the most hawkish out of all the central banks. They were the first ones to react. And, I think inflation in the UK, they thought was getting out of control quite early. They reacted early. And I think for the UK now, it is more about what is the terminal rate, the terminal interest rate in the UK. How high will they have to go? If you look at Europe, market expectations are for, once the ECB start hiking, they'll get to about 1%. I think the terminal rate in the US markets are estimated 1.5%. I think people will be looking to the Bank of England this week to figure out what the terminal rate is for the UK, and arguably it's going to be higher than 1.5%.
Okay, and thank you. And David, turning back to you now at this point, putting it all together, what does this mean for our clients? Are we sitting on our hands, or what are we seeing?
No, I think I've been trying to communicate a message in the weekly trader front page that I pen every week, just to try and give some color to what's happening in markets. And we've seen markets probably being oversold this time last week when we were speaking, and with any of these moves you do tend to get an overshoot to the downside. We saw that the DAX rally 8% almost in one day last week, which was probably an overshoot to the upside, but certainly there's a number of key indicators out there in relation to investor sentiment indicators, oversold conditions within markets that would suggest that a lot of the bad news is priced in to markets at this point in time. And as I started off by saying, I've been trying to communicate to clients in our weekly trader that an incremental deployment of cash into the market at these lower levels, if you're taking a 6 to 12 month time horizon, is never a bad thing to do. No one will ever catch the very bottom of the market. It's really a question of looking at particular names and stocks. We identified a couple in our trader, in our weekly trader yesterday. Any client speaking to any of our brokers will know that we like stocks like CRH and Smurfit's down at these levels. They're 20% off from where they were at the start of the crisis. They're trading at very attractive multiples and at very attractive valuations. So, incrementally adding money to those type of names, I think over a period of time will be well rewarded. That's not to say we're out of the woods yet. Clearly, headlines overnight out of Asia in relation to the lockdown in China, what that may do to, Ryan mentioned that their supply constrained inflation that the Fed and the ECB have been looking at. Are we going to see more lockdowns in China that will disrupt international supply chains? That's a factor, again, more that the central banks would have to look at. On the geopolitical side, are China siding with Russia? What will that do to US-Chinese relationships? So there's quite a lot of moving parts still. and the obvious one is still we don't have a resolution in Ukraine, and while talks are ongoing, you have to be very skeptical about the commitment of the Russians to a long-lasting peace agreement in the region. So still we expect volatility, but would be adding some exposure down at these lower levels.
Thank you so much, David. So insightful as always. And Ryan, thank you very much for your comments there. I think it gives a great flavor of what we're thinking about inside in Cantor when we're putting together portfolios for clients and putting together investment ideas for our clients. I would caution markets remain incredibly volatile, and it's definitely worth having a conversation with your broker. We are going to be continuing to do these weekly webinars for our clients while the current turmoil persists. Thank you so much for your time.